There is a number so large, so deliberately buried in government paperwork, that most Americans go their entire lives without ever feeling its weight. But right now, that number is moving, and when a number that big starts moving, everything else gets dragged with it. On May 16, 2025, something happened that hadn't occurred since the First World War. The United States of America lost its final perfect credit rating, not from some fringe newsletter, not from a foreign adversary trying to talk down American power, from Moody's, one of the three most respected rating agencies on Earth. The last one still willing to call us debt risk-free. After 108 unbroken years through 2 world wars, the Great Depression, Vietnam, 2008, it was finally over. Most people scrolled past it. That was a mistake. Because that downgrade wasn't the beginning of the story. It was the moment the story became impossible to ignore. And what's been building behind closed doors quietly for decades is the kind of financial crisis that rewrites the rules of the global economy. The US debt problem didn't explode overnight. It crept. For 30 years, every administration, Republican, Democrat, it made no difference, chose short-term relief over long-term discipline. Tax cuts here, stimulus packages there, wars that never ended, healthcare programs that kept expanding, and every time the bill came due, Congress did the exact same thing, raised the debt ceiling, bought more time, and kicked the can so far down the road that the next generation couldn't even see where it landed. By 2008, the entire US Treasury market was worth around $5 trillion. Today, $29 trillion. That's not economic growth. That's a government addicted to borrowing, financing that addiction with more borrowing, and calling it fiscal management. Here's a number that should stop you cold. Over the last 12 months, the federal government spent $7.1 trillion. That breaks down to $225,000 every single second, not per minute, per second. And most of it didn't build anything new. A massive growing chunk went straight toward paying interest on money already owed, debt that existed long before most voters ever cast a ballot. Here's a number that should stop you cold. Over the last 12 months, the federal government spent $7.1 trillion. That breaks down to $225,000 every single second, not per minute, per second. And most of it didn't build anything new. A massive growing chunk went straight toward paying interest on money already owed, debt that existed long before most voters ever cast a ballot. For the first time in American history, annual interest payments on the national debt crossed $1 trillion. $1 trillion, more than the entire defense budget, more than Medicare. The US government is now spending more money servicing its debt than it spends protecting its citizens or caring for its elderly. That is not a warning sign on the horizon. That is the emergency sitting quietly in the budget spreadsheet while Washington argues about everything else. And then Moody's pulled the last thread. S&P had downgraded the U.S. back in 2011 after a brutal debt ceiling standoff nearly sent the country into default. Markets panicked, politicians screamed. Then nothing happened. The U.S. kept borrowing. Fitch followed in 2023, citing what it diplomatically called steady deterioration in standards of governance, a polite way of saying Washington was functionally broken. But Moody's held firm. Moody's had kept that AAA rating intact since 1917, until May 16, 2025, when they finally said, enough. Their reasoning was surgical. Federal debt had reached $36 trillion, 98% of GDP. Interest costs had ballooned from 9% of federal revenue in 2021 to 18% by 2024. By 2035, Moody's projected that number hitting 30%. 30 cents of every dollar the government collects gone, before a single service is funded, before a single soldier is paid, before a single road gets fixed. Both parties built this together. That part never makes the talking points. Now here's where the story takes a turn that most financial coverage completely misses. The downgrade itself wasn't the trigger. The bond market was already sending a very different kind of message, one that doesn't use words. It uses yields. When investors trust a government, they accept lower returns on its bonds. When doubt sets in, they demand more. That's the deal. And right now the market is demanding significantly more. The yield on the 30-year Treasury bond cracked 5%, then 5.1, then 5.2, the highest level since before the 2008 financial crisis. Goldman Sachs is now openly projecting those yields could breach 6%, a level unseen in over 2 decades. Bank of America's chief investment strategist put it plainly: a sustained move above 5% on the 30-year is where, in his words, the door to doom starts to open. This is the bond vigilantes at work. You may not have heard that term before, but you need to know it. Bond vigilantes are the large institutional investors, pension funds, sovereign wealth funds, hedge funds who punish reckless governments by dumping their bonds, driving yields higher, and making every dollar of new borrowing more expensive. It's the market's version of a disciplinary action. They had been holding their fire for years, watching, waiting to see if Washington would get serious about the numbers. They stopped waiting. Here's why that matters beyond the headlines. The United States had to refinance roughly $9.2 trillion in debt that came due in 2025 alone. The majority of that debt was originally issued when interest rates were near zero. Rolling it over at today's higher rates is a different calculation entirely. Every $1 trillion refinanced at 2% higher than before adds $20 billion to the annual interest bill. Multiply that across the full picture, an estimated $28 trillion needing to be rolled over in just 4 years, and you start to see the spiral. Higher rates force more borrowing to cover interest. More borrowing pushes rates higher still. More bonds flood the market, depressing their value, pushing yields up further. This is not a projection. This is the mechanism already running, and the buyers are leaving. China's Treasury holdings dropped to $652 billion by early 2026, the lowest level since 2008, down from a peak of $1.3 trillion just over a decade ago. Japan, the single largest foreign holder, shed $47 billion in a single month. Meanwhile, China has been doing something that deserves serious attention: aggressively buying gold. The share of US Treasuries inside China's foreign reserves has dropped 15 percentage points since 2016. Gold's share has doubled. Nassim Taleb, the man who wrote the book on catastrophic risk, declared that gold has already effectively replaced the dollar as the world's true reserve currency, not in 50 years, now. The Federal Reserve is not riding to the rescue either. It has been actively shrinking its own balance sheet, selling off $2.3 trillion in assets, mostly treasuries. So the foreign buyers are pulling back, the Fed is pulling back, and the government needs to sell more bonds than at any point in history. The question that keeps serious money managers awake at night: who exactly is left to buy? Former Treasury Secretary Henry Paulson answered it as directly as anyone in a position like his ever does. He said the reliability of Treasury securities is breaking down, and if demand eventually collapses, what the U.S. faces isn't just high interest rates. It's the end of the borrowing model itself. Look at the United Kingdom in 2022. Prime Minister Liz Truss unveiled an economic package the markets didn't believe in. The bond market revolted in real time. Yields spiked, the pound cratered, pension funds nearly collapsed. She was forced from office in 44 days. The bond market moved faster than the political system could respond. Britain had a relatively small, contained bond market compared to the US. America's Treasury market is bigger, deeper, and more liquid. That buys time. But time is not immunity, and the clock is running faster than at any point since the post-war era. Former Reagan budget director David Stockman called Trump's fiscal package the one big beautiful bill, a big ugly bomb. If current policy holds, his projections show the federal deficit approaching $3 trillion annually by 2035. The national debt would surge from $37 trillion to over $58 trillion in just 10 years. The Congressional Budget Office projects further. By 2055, the debt could reach $150 trillion. $150 trillion. It took the United States 250 years to build up its first $37 trillion in debt. The country is now on pace to add another $30 trillion in the coming decade alone. Here's the part nobody says clearly on television. America doesn't go broke the way an individual goes broke. There's no single moment of default, no lock on the door. What happens is quieter, and in some ways far more dangerous. Confidence erodes slowly, then all at once, foreign governments stop showing up to Treasury auctions with the same appetite, yields move a little higher. Mortgages get more expensive, business loans tighten. The economy slows, tax revenues fall, the deficit grows wider, more bonds need to be sold. The cycle feeds itself until the people running the money make a decision the political class has been too scared to make for 50 years. The real collapse isn't a single dramatic event. It's a slow-motion erosion of the one thing that made American debt special in the first place, the unshakable belief that the US always pays, the dollar always holds, and a treasury bond is the safest place on earth to store wealth. That belief is no longer unshakable. Moody's didn't. The bond vigilantes didn't cause this. Washington did across 30 years, across both parties, across every administration that chose the next election cycle over the next generation. The United States is not broke yet, but for the first time in modern history, you can actually see the edge from here. And the people who manage the serious money, the ones who don't do press conferences, don't run for office, and don't post on social media, they have already started moving. Pay attention to where they're going. If this video changed how you're thinking about your own financial picture, share it with someone who needs to hear it. And if you want to keep watching the numbers that actually matter, you know what to do.